Good afternoon. I'm Steve Farkas, Assistant Dean for the College of Business, and thank you again for joining us for our fourth COVID Business Information Session. We are pleased once again to have members from our economics team sharing insights into the economic impacts of the COVID crisis. If you happen to have a question during today's program, please submit your questions using the Zoom chat feature during the presentation. In the event we have time left in the hour, we'll attempt to answer. If not, your questions with answers from our experts will be updated on our COVID information website FAQs where you registered for today's event. Before I turn it over to Dave Adlin, I'd like to quickly share with you important information from our Wyoming Business Council partners regarding the new Wyoming Business Relief Program. Our legislature recently created 3 grant programs to distribute $325 million in federal CARES Act funding for Wyoming small business owners who have experienced hardship related to COVID-19. The Wyoming Business Council has created an informational website to assist businesses with navigating this new program. Please visit wildbizrelief.org. There you'll find rules, application criteria, and FAQs. Additionally, the Business Council is hosting a number of webinars. For those that may have missed the first 2, you will note a session this afternoon at 4 p.m., followed by 2 more on June 4th. Please note the registration link, wildbizrelief.org. You are also encouraged to contact your Business Council Regional Director for additional details. Okay, let's move on to our program. Joining us today are David Adlin, who is the chair of our Economics Department and our Center for Business and Economic Analysis co-director, Ann Alexander, who is interim provost for the University of Wyoming and vice president for academic affairs, Ben Cook, who's our director of the MBA program and a Center for Business and Economic Analysis co-director, and Rod Godby, who's associate dean for the Hobbs School of Environment and Natural Resources and also deputy director for the Center for Energy and Regulatory Policy. Dave, I'd like to turn it over to you.
Hi, everyone. My name is Dave Adlin, as Steve said. I'm the chair of the Economics Department, and I'm the co-director of the CBEA. So my plan here is I want to spend a little bit of time and just introduce you to this new center we have, CBEA, and then I'm going to give you sort of a high-level overview of the macroeconomic effects of COVID-19 and the federal policy response. So just give me 1 second here while I gain control of the slides. Okay. Okay, here we go. So let me tell you a little bit about this new Center for Business and Economic Analysis we have called the CBEA. It was started here in 2017 with some seed money from the university. We did a little bit of research and we realized that all 50 states have one of these centers, except for Wyoming, and so we needed to fix that, and now all 50 states have a center. The idea behind the center is to support economic growth and diversification for Wyoming through economic and business analytics. So the bread and butter of these centers are economic impact analysis, but we can do more than that. We can provide lots of different types of business and economic support that industry and policymakers may need. When the center matures, the plan is to have regular meetings and outreach with the state where we go around the state and give presentations to industry, policymakers, and talk about Wyoming's economy and then local issues. So right now, the personnel for the center are Ben Cook and myself. Ben, you'll be hearing from Ben later. We're serving as co-directors right now. In the future, our director will be Ann Alexander, who will be talking right after me. We've been working with several different clients. Just a sampling of those clients we've been working with the Wyoming Business Council, Jenner, Laramie Jubilee Days Committee, State Parks and Cultural Resources Division at the state of Wyoming, and Power Wyoming. So now let me switch over and talk a little bit about the give you an overview of the macroeconomic effects of COVID-19. Okay, so I'm going to start with the impact on GDP. And just as a quick reminder, GDP stands for Gross Domestic Product, and it's the value of all final goods and services in an economy. So a very comprehensive measure of economic output. So prior to COVID-19, let's say 2019, just to give you some perspective, the current dollar value of GDP was somewhere in the neighborhood of $21.5 trillion. And then when COVID-19 hit, right around March, real GDP fell by 1.2% in quarter number one. So I'm going to take my mouse, I hope you can see it here. This little dip in GDP that was growing over the last few years, this is the first quarter impact of COVID. It's a fairly modest impact, but it's primarily because the pandemic didn't really start until March 1. This is a quarterly impact. So this data also includes January and February when there wasn't as much of an impact. Now the CBO Congressional Budget Office projects that real GDP is going to fall by somewhere in the neighborhood of 12.2% in the second quarter. So April, May, and June of this year. So 12.2% fall in real GDP, that's inflation adjusted GDP, is a very sharp decline. And I put the graph over here on the left that shows real GDP climbing since the Great Recession around 2008, and it was climbing. And then I drew this red line here to show what a 12.2% decline in GDP in the second quarter would look like. And just if you were to take the end of this, how far real GDP would fall, and if you sort of trace it over horizontally, this would equate with the amount of real GDP they had in 2014. So we could say that basically COVID through the first and second quarters of 2020 basically erases all of the economic growth gains for the last 6 years since 2014. Okay, so now let me switch a little bit and talk about what the federal policy response was to this. So I'm going to first talk about fiscal policy, and then I'll switch over to monetary policy. So as many of you know, Congress passed the CARES Act, and the CARES Act is CARES is an acronym for Coronavirus Aid, Relief, and Economic Security Act. And this act, just to give you an idea of the size of it, was a $2 trillion fiscal response, an emergency response to provide emergency support to a lot of different groups. Just to put that in perspective, right? The GDP was about $21.5 trillion, so it's about 10% or a little less of GDP. So it's a very sizable fiscal stimulus. It provides support for a number of different groups, households. You guys are probably familiar with the $1,200 checks or direct deposits that were given to individuals, plus $500 for dependents. There was support for small businesses, PPP program, many of you may be familiar with, support for big businesses, healthcare, state and local governments like Wyoming, which I think we'll hear about more later, and education, to name a few. The CARES Act had bipartisan support. It passed unanimously in the Senate, but one concern is it is going to add to our debt, and some people have concerns about this. So I provided a graph on the left that shows the debt to GDP ratio. This is usually how we measure debt, as a fraction, as a percentage of GDP. So you can see here, if you follow my mouse, that up until the pandemic hit in say 2019, the debt to GDP ratio was approximately 80%. So this is debt held by the public, and then the projection is by the CBO that this is going to shoot up to about 100% in the next year, 2020. And of course, this is due to lots of different factors. It's due to the fiscal stimulus, which is going to cost $2 trillion. There's going to be extra unemployment insurance benefits that have to be paid out, and of course, reduced tax revenues. And all of that's going to increase the debt to GDP ratio to nearly 100%. Okay, so let me switch over a little bit to monetary policy response. So how did the Federal Reserve lowered the federal funds rate to about as low as they can, to 0. And that's where it sits right now. In addition, they enacted something called quantitative easing. You may have heard of this, sometimes called just QE. You can see over here in the graph, I've provided a graph of the monetary base, which are currency and reserves in the US, reserves in the banking system. And you can see after 2008 and the Great Recession, kind of a stair-step pattern for the monetary base. That's just a number of rounds of quantitative easing. What quantitative easing is the Federal Reserve, our central bank, buying up government securities on the open market. And when they do this, they put reserves into the banking system, which can increase the money supply and increase liquidity in the banking system. You can see in 2020, you can see a sharp increase in the monetary base, and that's one of the one of the monetary responses of the Federal Reserve. But they can do more than just control interest rates through the federal funds rate and quantitative easing. They have some other tools at their discretion. And I'll just give you a sampling of them, and then I'll turn it over to Ann. One is called forward guidance. Forward guidance is just a term that basically says the Federal Reserve is going to be very transparent about where policy is going to go in the future. So they can say things like, we're going to keep the federal funds rate at 0 for the next 2 years, or we're going to continue to do more quantitative easing. So forward guidance, is just being very transparent about the future path of monetary policy. They can provide more liquidity into the banking system, and they can do this through a number of different ways. One is by directly lending to banks through the discount window, and they've done that. They've done it by also lowering reserve requirements the banks have to hold on new deposits that come into the banking system. And finally, another thing they can do is they can provide a backstop lending for the fiscal response, this CARES Act. And all three of these are a way of providing liquidity in the banking system and help to lessen the effects of COVID on the economy. So I'm now going to switch over and let Ann take over. Thank you.
Thanks, Dave. That was a really great way to set the table here. And just for context, everybody, we did not provide our own title slides. So thanks to Kat for saying okay, I'm sorry about that. I said a lot of really insightful things while I was muted. So anyway, Kat came up with these title slides, not us. So thanks for the compliment. I appreciate that. And hopefully, let's see if there we go. All right. So my role here today is to unpack the employment situation report that you hear that rolling out at the beginning of every month about the previous month's employment situation. And just for a little bit of context, as Dr. Adlin said just a couple minutes ago, GDP growth had been really strong and steady in the lead up to 2020 and even in the early part of Q1 in 2020. But of course, that was before the pandemic hit. But we were in the midst of the longest economic expansion in the history of the Republic, and our labor force was well deployed. Really low unemployment, really strong labor force, and a very large number of people participating in the workplace. And then, of course, everything changed. We starting in March, started to see the impact of COVID-19. And that has caused wreaked all sorts of havoc on our employment situation. Now, the employment situation report that comes out every month is comprised of data that comes from two different surveys. One is a household survey. It's a random sample of people just like you and me that get asked questions about their employment status, among many other things. And the other part of the survey is an establishment level survey. And that means firms, small businesses, large businesses, all businesses. It's a sample of those employers throughout the economy. And from those surveys, the Bureau of Labor Statistics pulls together the employment situation report. The headline number that you always hear about is, of course, the unemployment rate, but really there are actually 6 measures of unemployment that are measured by the employment situation report, and a lot of data crunching that goes into that. And so for the past several years, since the recovery from the Great Recession, we've been marching forward with sort of really great unemployment numbers. The expansion has not been universally awesome for every single person, But nevertheless, the general labor force situation was pretty good. But in the past 3 months, we have seen a substantial exponential increase in initial unemployment claims. For March and April, it was 30 million initial unemployment claims, an additional 10 million in the month of May. We've lost approximately 30 million jobs in that entire period. And the employment situation last month, of course, came out, and a couple of my buddies said, hey, at least, there were terrible unemployment numbers, but at least there was wage growth, right? And I said, no, that's actually not good news, because what that meant, this 4.8% increase in wages on average, reflected that there was a large loss of employment at the lower income levels. And so this is just unprecedented times. And one thing that I often like to look at in those employment situation reports, and when those come out, one will come out again very shortly that will look at May. But some of the things I like to look at, and all of these fine gentlemen here also, tend to look at things like the labor force participation rate. The headline number is really interesting and important, but the more interesting and important data is probably the labor force participation rate and another thing that's called U6, which I'll show in just a second. The labor force participation rate is just this. It's the number of unemployed people plus the number of employed people on top there in the numerator. And then the bottom, the civilian non-institutionalized population. So people who aren't in jail, people who aren't in the military, people who are not out of the labor force taking care of children, etc. This number should tell you basically the number of people that are really, kind of out there looking for a job, wanting a job, trying to get a job, and maybe finding a job eventually. But there are some significant limitations. And those limitations are particularly acute when you have a recession, when you have a really deep recession, particularly. If you're unemployed and you've given up looking because you are now discouraged, you have a census worker who visits you, calls you, comes to your house every so often in this survey and says, hey, do you have a job? Hey, do you have a job? Hey, do you have a job? Every week. And if you don't have a job for a long time, you start to go, yeah, sure. I don't know. I'm not even looking anymore. I've given up. So this labor force number is something to really watch, because there are some limitations to it that are most acute during recessions. And in any given time, it has some other limitations to it as well. But the labor force participation rate, this graph shows you all the way going back to 2003. Normally, I don't show graphs that go all the way back to 2003 because that's a lot of data. But this shows that the labor force dropped during the Great Recession. Labor force participation rate dropped during the Great Recession right about here. And it started to stabilize about here. And then that next little cliff right here, that was last month. 1 month, 3% decline in the labor force participation rate, unprecedented. So something to watch when those numbers come out and you start to unpack that employment situation report. The headline unemployment rate in January, reflecting the strong GDP growth that Dr. Adlin mentioned, was at 3.5%, was in February, started creeping up in March because that's when the pandemic really started to emerge as a major macroeconomic threat. And then during April, when many of the stay-at-home orders began to be enforced. So 14.7%. Unprecedented. How many times do I get to say that word today? There's a graph, and again, this goes way back to 2003, again to show right here, this bump in the middle, that's the Great Recession. The unemployment rate was verging up at about 10% almost, and now it is well over 14%. Another thing that I think it's important to look at in that employment situation report, and sometimes gets reported on places like CNBC, is this. This is sometimes called U6, not sometimes, it is called U6, but what it means is it's the percentage of the labor force who want full-time work but can't find full-time work. And this again goes back to 2003 to show for context the difference or the escalation of that number during the Great Recession And then the giant, massive, I don't know what that is, cliff over, it's not a cliff, it's the opposite of a cliff, the giant face of a mountain over there on the right-hand side. If you look at that for context, in the worst of the Great Recession, 17.1% of the civilian workforce was wanted to work full-time but could not find full-time work. That number, as of last month, was almost 23% of the civilian workforce. So again, an incredible headwind for our economy and certainly for our labor force. Coming back to where these jobs are, the most vulnerable positions to this shutdown or to the effects of the shutdown were in, of course, often lower wage jobs, primarily and very hard hit in accommodation and leisure. But this also shows you the breakdown with respect to small business versus other. The larger the blue bar is there, the more localized you probably are as an industry, and the smaller the firms are that make up that industry. So you can see that there's a pretty significant impact on small businesses and their employees here. If you look at the Wyoming employment situation, this, again, looking at numbers that we've never, ever seen before. As of the week that ended May 9th, we had almost 43,000 initial unemployment claims in Wyoming. And for context, that's 60% over the month increase. That's a 60% over the month increase and a 1,025% increase relative to May of the previous year. So that's pretty significant. Again, employment job numbers fell by 14,000 from March to April. And finally, the unemployment rate went up a little less than 6% from March to April. There's smart men up here that are going to tell you more about what that looks like in the future. This is just a bar graph that shows you in orange the number of jobs or employment in the state, and that goes kind of off a cliff here over in April. And this yellow line shows you the unemployment rate, showing that increase of about 6% from 3% to about 9%. If you look at where the majority of the initial claims have been in the past few months, the majority of the initial claims have, no surprise, been in leisure and hospitality and retail. As well, you see healthcare and social assistance, because it's particularly in healthcare, a lot of things that were not crisis related. So any kind of elective surgery, PP, those kinds of things had to be completely stopped during the stay-at-home orders. If you look at continuing claims, this is more of like the headwinds that are coming at us all the time anyway in the construction and mining sector. And then you again see the impact in leisure and hospitality, where these are, if you look at the highlighted things here, these are the revenue generators for our state, right? Leisure and hospitality and tourism and construction and mining, that's where a lot of our income and revenue generation comes from. So that's something to keep in mind. And now, without further ado, on to Dr. Cook.
Hi, thanks, Ann. I guess everyone at this point understands why they call us the dismal science, as these economists get on here and show you a bunch of numbers that are non-optimistic in some ways. Prior to taking over the MBA program, I was the energy economist for the Enhanced Oil Recovery Institute. So I'm going to spend some time continuing to bring it down from that macro level to talk about Wyoming and talk about energy in particular. I don't think it's any secret on this call that energy is a massive part of Wyoming's economy. Most of you are familiar with that. But I think sometimes we don't always see the numbers. We know as citizens of our state that it's a massive part of our economy, but just how big is it? If you actually look at the Bureau of Economic Analysis, they break down GDP for Wyoming across different sectors. And mining, oil, and gas produce well over a quarter of the output in Wyoming. The next biggest sector is government with 13.7%. And when you think at 13.7%, just to give you a sense of whether that's large or small, Montana, for instance, is about 14.4%. Idaho is about 13%. The Dakotas are lower at about 11.5% of government as part of their GDP. Utah, Colorado, right about 12%. So we're probably at the upper end of those states in terms of the range, but just to give you a sense of where we sit relative to some of our neighbors there. So a quarter of our economy. Now, historically, you may have heard in the past that maybe 2/3 of our state and local revenues come from mineral sources. That was true for a small point in time, actually, when we had a massive boom in natural gas production. At the same time, we had really high natural gas prices. The Wyoming Taxpayer Association has tried to keep better track of this more recently, and in 2017 had this report that basically said it's just over 50% of our state and local revenue. So that gives you a sense of where our state budgets and local budgets are coming from, about over 50% dependence on minerals in general. Now, when the legislature meets, they're given something called the Budget Fiscal Data Book. And this is just a summary of some information that's in that fiscal data book. You can look at it on the legislature's website. But one thing the legislature always is given is how big of an impact price changes on minerals or production changes on minerals have on our overall budget. So there's 2 pages in that report that just say, here's how everything changes if we modify oil prices or gas prices or whatever. You can see a $5 change in the oil price leads to a $53 million change in government revenues from severance taxes, federal royalties, and ad valorem, or the property taxes on those mineral assets. And that number actually excludes the sales and use part. And I'll bring up the sales and use part in a minute. Natural gas, really significant. Just a 50-cent change in the price of natural gas can have almost a $88 million impact on these 3 sources of revenues for our state. So the thing about COVID is that we ended up we get hit twice sort of in Wyoming because of our mineral dependence. We don't just have the impact that everyone else is sharing with GDP changes and unemployment and things like that as a result of this pandemic-induced recession, but that completely changed energy consumption patterns with respect to electricity and fuels generally, transportation fuels especially. We've seen a massive decline in electricity consumption and oil consumption as planes quit flying and cars quit driving. And so we get hit with a whole other round of impacts from this. Again, the purpose of my talk is to give you some perspective about energy production in Wyoming, because I don't think everyone always looks at what those numbers really look like and what the trends really look like. What this chart shows you is Wyoming coal production measured on the left-hand side in short tons of coal produced per year, going back to 2000. That's the blue bars there. And we peaked or topped out close to 450 million tons per year in 2010, okay? Since that time, we've been in pretty steady decline in overall coal production in our state through the end of 2019. The black line measured on the right-hand side is the percentage of US electricity that's generated by coal. And that number is falling. It's falling fast, and it's falling closer to 20% now. A lot of that fall, if you actually look at where generation's coming from, has actually come from massive increases in how much natural gas we use for electricity production. We talk a lot about wind and renewables, and that's a significant part of the story, and it's not unimportant. But as natural gas prices have tanked and have gotten so cheap, it's actually cheaper for us to produce energy with natural gas turbines. You get half the CO2 emissions. They're easier to turn on and off. And there's a lot of other advantage to this that comes. So when you have low natural gas prices, people just gravitate and switch fuels. So there's not really an end in sight to this downward trend in coal. Just to give you a sense of that, we're probably going to be well under 300 million a year for this year and probably going forward. If you look at gas production, natural gas production in our state, natural gas production was a tremendous blessing for Wyoming for a long period of time, going back to the late 90s. We had strong natural gas prices. We had a lot of coal bed methane being produced in the state. This is monthly gas production from the Oil and Gas Commission. And you can see that continued, that upward trend in production, which is this black line is measured on the right-hand axis, pretty much peaked right about the same time as the Great Recession. We had pretty strong natural gas prices above $6 per million BTU or per MCF, depending on how you want to think of that. But pretty much since that time, since the Great Recession, gas prices have, as measured by the red line on the left-hand axis, have easily been below $4 an MCF. And actually in Wyoming, that number is lower. I believe I saw Jim Robinson on the call as well. He can talk about differentials a little bit. But just because that's the Henry Hub natural gas price, that doesn't mean that's what we get for it in Wyoming. So the Opal Hub and the Cheyenne Hub, we could be looking at 20 cents, 50 cents lower than the Henry Hub or NYMEX contract natural gas price. And our natural gas production's been in pretty steady decline going back to 2008, 2009. Ultra Petroleum, the largest producer in the state, just declared bankruptcy. We haven't had a lot of sustained natural gas drilling for some time in Wyoming. If I go now to, and I'll leave it to Dr. Godby a little bit to talk about the future and where we think things are going forward. This chart is a little busier. You've got the rig count and the WTI oil price. The red line is oil prices. The dotted line is the rig count. And then production is that solid black line is measured on the right-hand axis. Oil is volatile, but it's actually been a good story for us in some respects. Although we had a steep decline in oil prices going back in 2014 that resulted in a decline in Wyoming's oil production from 2014 through 2016. As we saw oil prices start to maintain and sustain right around or above $50 a barrel, we actually saw a really great resurgence in oil production in Wyoming. As horizontal drilling came online, rigs started moving and being deployed in our state. Now, with this massive supply impact, we have too much supply in the market, we're not consuming it. We've seen a huge decline already starting to show up into the system. And looking at oil production in the future, this is not necessarily something we can count on to bail us out of the long-term declines in coal production and natural gas production. So I'm going to talk a little bit about taxes. Minerals assessed in our state are assessed at 100% of the prior year's production value. So whatever oil field produced in the prior year, 100% of that value is what's used as its assessed tax base for ad valorem taxes. And when you think about that compared to commercial property or residential property, you're really only assessing your home 9 or 10% of the value of your home. What that means in terms of the tax base for Wyoming is that it basically takes about 10 times as much commercial and residential property value to replace the lost value in the mineral industry. So I'm going to go to a chart here. The black line is the assessed value of all minerals in the state of Wyoming. You'll notice in 2014, there is a precipitous decline in the assessed value as measured on the billions of dollars on the right-hand side here, down to below $10 billion for all minerals measured in our state. This assessed value is basically $5 billion below where it sort of was sitting from 2009 to 2014. So to replace $5 billion of lost assessed value on the mineral side, you would actually need almost $50 billion of commercial and residential valuation to replace that, simply because of the way we assess property taxes. And I think when we start talking about diversifying our economy, it's part of the challenge for how do we translate diversification into revenues for our state and local governments to supply public goods and services. The other takeaway from this chart is the orange and blue lines. I chose orange and blue because I'm a Broncos fan, so I apologize for that indulgence. But the way you read this just changes fiscal year over fiscal year to collections of sales and use taxes for the state. This includes state collection as well as county level collections. If you just focus on 2014, where we had a huge drop in oil prices, we had a massive decline in sales and use tax collections, the orange portion of that bar represents about 6 industrial sectors to include oil and gas extraction, coal mining, oil and gas and mining support services, machinery purchases, machinery rentals, and petroleum wholesalers. Those six industrial sectors represented about 62% of the change in sales and use taxes. And so even though on average, the energy economy only represents about 30% of total sales and use tax collections, the year-to-year changes are closer to 50 or 60%. So when we look at changes year to year, about 50% of those changes in sales and use tax are coming from changes in our mineral and extractive industries, which again ties in. We've got property taxes significantly dependent on minerals, sales and use taxes significantly tied to minerals, And of course, we start looking at severance taxes, and those are inherently tied to minerals. This is where the challenges come in. So when the Endow Council started talking about diversification, and Remy, an outside firm, came in to look at diversification and how that affects our state and our expenditures and our budget, a key finding from their study that was put out is this quote right here: under current tax structure, Wyoming effort to stimulate non-resource sectors in the state presents fiscal challenges. Only growth in resource sectors have significant positive fiscal impact. So that sets the stage for what I think Dr. Godbee is going to help us understand a little bit more. When we start talking about a structural budget deficit in Wyoming, what we're talking about is this complete change in our energy economy that's forecast to have a permanent effect on our budget going forward. And that means we have some difficult choices to make. And it also is related to our effort to diversify. Basically, that you can't simply diversify your way out of the budget problems we have because of the way we tax. The final pin that I'll put in that point is this study from the Wyoming Taxpayer Association, and Dr. Godbee was good enough to grant me use of this slide here, is our public service costs for a typical 3-person household, about $60,000 of income. We're spending about $27,000 per household there on public services. And you can see the breakdown between, state services, K through 12 education is always a massive one, and local expenditures. But on average, that household is only paying about $3,000 of taxes from sales use, gasoline, and property taxes. So there's this huge gap there that historically and traditionally has been filled in Wyoming by our mineral sector and our extractive industries. And now we're faced with a situation with a structural decline in that energy sector, and trying to figure out how to fill that gap between our tax collections and how much we're spending on public goods, and balancing that trade-off between how much do we want to spend on public services in our state versus how much are people really willing to pay in taxes. And with that, I'll turn it over to Dr. Godbee.
So thanks, everybody. Thanks, Ben. Thanks, Ann. And thanks, Dave. I'm Rob Godbee. I'm now the Associate Dean of the Hobbs School of Environment and Natural Resources. Prior to that,
Rob, you're on mute.
all right, can you hear me now? All right, can anybody hear me?
Yes.
All right, thanks for that. So this is what happens when your computer goes to sleep. So hopefully people in the audience haven't done so too. So I'm actually the Associate Dean of the Hobbs School of Environment and Natural Resources, also a member of the Economics Department. So thanks, Dave, Ann, and Ben for that. So basically you've seen what the COVID crisis has done to the economy. Dave's talked about our responses to it. Anne has talked about how it's hit employment, which is really closest to home for most people, right? That's our ability to create a means to sustain ourselves and our families. And Ben's talked a little bit about the real challenges we face in this state, because not only are we taking it on the chin in terms of business activity, but we're also taking it on the chin in terms of energy production. And that is not only affecting our economic activity, but also affecting our ability to collect revenues. And as he showed, we already had a major problem there. We rely too much on energy, and that's led to what we call a structural budget deficit. So I'll just show you what that means. So just a quick recap of the energy numbers that Ben has shown you. Everybody's aware of coal declines. In the last 5 years prior to COVID, employment had dropped almost 20%, production's down over a quarter just in 5 years. And the revenues from that is actually, they've dropped even more, reflecting previous years, down by 32%. If we look at gas, as Ben said, that's also been declining, and people have often been unaware of that. That's primarily due to the natural decline rate of the wells in Wyoming and the fact that fracking has allowed people to produce gas elsewhere. So again, employment's down over 10%, production almost 20%, and our tax revenue's about the same. So that puts us in a bit of trouble, given that some people joke that Wyoming is well diversified in the sense that we produce coal, oil, and gas. But two of the three horses in the stable have been faltering lately. And really that left it to oil to kind of pick up the load. And as Ben showed, oil has really grown significantly over the past decade. And just in the past 5 years, it's grown by 14% in employment, almost 30% in output, and taxes are now beginning to catch up. This is our major tax producer, or has been, until COVID. So that's kind of how we have to look at this. Three horses in the barn, two of them are kind of sick and ailing, and one of them had to take up the load of the other three. And if you think about our revenue structure, that means that we originally kind of had a tricycle, nice and stable. It's nothing to write home about, not super exciting, but that's why we put little kids on tricycles, right? They don't fall over very easily. As coal began to decline, we kind of went to the bicycle model, which is still pretty stable. People know how to ride bicycles. That was really oil and gas. But what people didn't realize is that we're really moving to this unicycle model. And of course, most of us can't ride a unicycle without really hurting ourselves. And the reason for that is because it's so unstable. So I often call this the unicycle model of revenues. You could sometimes people talk about three legs of our stool, where two of them have been getting progressively shorter and the stool's kind of tilting over. That was pre-COVID. So let me just show you a little bit of what we expected our energy revenue to look like. So this was back last fall when the Craig committee, I sit on that committee as part of the consensus revenue estimating group for the state. The dotted line is what we estimated our revenue looked like going out to 2024. The colored lines are actually energy scenarios put out by the Energy Information Agency of the Department of Energy. And you can see that we were actually around the pessimistic side. And the reason for that is because those scenarios came out about 8-9 months before Craig. And so they don't incorporate the most recent information. So the bottom line is you can think of Craig as an update over what had happened the previous year. And you can already see that there was a decline in what was expected in energy. Instead of the blue line, which is kind of the reference with a low and a high around it, the Craig report was saying, 8 months after that came out, that our energy revenues, our total energy value, if you want to think of that, and all three minerals, oil, gas, and coal, was actually declining. That was then updated in January of 2020. And you can see the Craig report had a minor modification. We didn't change the forecasts for energy commodities, but we did change gas and its price for 2020 because we were too high. And that's what led to that little dip in the dotted line. But because we didn't change the other commodities, you can see that now the Craig report goes from being one of the more pessimistic forecasts to actually more optimistic than any forecast in 2020. So what does that tell us? That tells us that even before COVID, we were facing a major problem with respect to our revenues. Energy forecasts for our state were actually declining, and lots of our revenue comes from that. So this is what it means for our budget. The Craig forecast is in the upper left corner. The blue line is our revenues. The orange line is our expenditures, just keeping a flat budget pretty much. And you can see the Craig forecast was actually forecasting a pretty large deficit, and we were only supposed to climb out of that late in 2023, 2024, and only because we were really assuming some significant increases in oil production. We continued to expect coal and gas to decline. With updated forecasts, which you can see in the other three figures, no matter which one you look at, the lines don't ever cross. And the blue line is below the orange, so revenue is less than expenditures. We're facing a deficit. We just didn't know how large it would be. And that's what we call our structural deficit. It's because we depend too much on energy. And going forward, coal is likely not to come back. Oil was growing, but gas was declining. And then COVID hit. So let me show you just back to those energy revenues what COVID did. And this was released in the most recent Craig report. That red line is now our revenues based on current conditions, the best guess that we have. So they're well below anything we expected. In fact, you can see that they dropped from about a total production value in Wyoming of about $13 billion down to about $8 billion. So we're looking at about a third or more decrease in the taxable base, which is going to create a third or more decrease in our revenues. Clearly, we have not had major changes in expenditure yet. And what that means is not only do we have a slow economy, not only did we have to change our taxes, and effectively what Ben showed you on his last slide was we have exported our taxes for years and made other people pay them for our public services. We were going to have to shoulder more of that burden if we wanted to keep the public services we've gotten used to. Now, if we want to keep those public services, we would have to shoulder quite a bit more, because basically, as you can see, the bottom has fallen out of what we expect our energy revenues to be. Now, I'll have a little caveat here. This is based on economic modeling, and the only thing we know for certain about economic models is they're always wrong. But the question is, are they in the right direction? And I think most people would argue absolutely. It's very hard to see a major energy recovery to where we were before. Coal just will not be coming back. It's been replaced by too many sources of energy. It can't get any cheaper. And, we are really uncertain what's going to happen to oil and gas. But let me show you just a few projections about what this means to our budget. So, first of all, what's driving this decline in our total energy revenues? And remember, I told you the best horse in the barn was oil. That was what was actually growing of the three energy commodities in our state. And if you look closely at Ben's chart of oil production, it was the case that oil production had never fallen more than 10% in a single year in Wyoming. That goes back to the 80s, through the busts in the 80s, the 90s, the Great Recession, and even just a few years ago. So 10% has kind of been the watershed moment of decline. Well, here to tell you that it's going to drop a lot more than that. We're expecting an almost 50% decline in our oil production, at least in the near term. And that's probably going to extend for a while, well below what we were used to. In addition to that, we've seen oil prices decline rapidly. A few weeks ago, they were even negative. What that means is that we expect for the year they're going to be down over 40%. So you take both of these declines, you put them together, and 75% of the revenue we expected from oil is gone. Basically because we've had a 50% decline in the production value and 50% decline in the pricing. So production total and pricing both fall by 50%. That's a decline of, 75. Well, we've only got 25% left. So our revenue has declined by 75% just in that one commodity for this year. And we don't expect those to recover back to that critical $50 threshold until possibly as late as 2024. And so our production will continue to be low, not just this year, but for several years. That's going to drag down activity in the state. It's going to drag down revenues in the state. But that's not all. Natural gas is expected to decline by an additional quarter in 2020, and that's just due to changes in energy demand and the fact that natural gas producers were already in trouble before this recession, and now they're in serious trouble given conditions. We don't expect that production to come back in the next few years either, and we expect both production and prices to still be about 10% below. So that's actually decreasing our expected revenue from gas by about a third. And then finally, coal, which of course has been the weakest horse in the barn for a while now. We're expecting coal declines to increase, well, and by that I mean get worse, by an additional 25% to what they already were, which was shaping up to be the worst year on record in the past 20 years. The good news, I suppose, about coal is the price really can't get too much lower. We're very close to production cost in coal production, so price won't fall that much. We're not expecting it to fall much more than about 2%, although we continue to expect the coal production to decline. So all three are in bad shape, but I guess this just goes to show you how things can change. What was the weakest horse in the stable is now the strongest, and that's coal. I shared these numbers with my colleagues in the economics department a few weeks ago. And then I shared them with colleagues in the Hobb School. In the Hobb School, they were so dismal that I decided to make a drinking game out of it, that every time I said shortfall, they were supposed to drink. I didn't do that for my econ colleagues because they already drink too much, because this is the sort of news they look at all the time. But in addition to those energy revenues, which are severance taxes, ad valorem taxes, and federal mineral royalties, our sales taxes are going to go down as well, as Ben showed. And we're expecting 2020 won't be terrible in the sense of how badly 21 is going to look, but we're expecting a huge drop, about 14% this year, which is going to increase about 30% next year. And that's really due to the reduction in all of that energy activity we're expecting. The current reduction is, a lot of it's due to just the decline in regular business activity that took place over March and April and will continue to be slow probably for the rest of the summer. And again, you can see those numbers don't come back very quickly, and that really reflects the outlook we have for energy. Add to that the property tax outlook, and this doesn't really get used to balance our budget so much as pay for education in the state. And as you can see, the property tax outlook is pretty dire as well. We're looking at 20% declines through this year, next year, and the following. And they don't get much better in the 2 out years after that. In reference, last year we actually gained 1.5%. So we've really been hit hard by this recession. So what does that all mean for the state? Just the fiscal year that's left, which is this month, June, we're going to be 200 million short of what we expected in the general fund, and about 39 million short to education, which means we're already starting the new fiscal year well behind. But then going forward, our general budget funded by the general fund, we expect about a $900 million shortfall. And to give you a sense of how big that is, that's about 30% of the total budget passed in March for the general, funded by the general fund. In addition, in the next 2 years, we're expecting a decline of about 357 million for schools, which also has to be covered somehow. So altogether, and you've probably seen these numbers in the news, if you look at the total shortfalls this year and then the coming 2 years, we're about 1.5 billion short. And so that means we're going to have to tighten a lot of things in this state, and everybody's going to feel it. So what are our choices? Obviously, we could cut, and that's the first thing we'll look at. It's natural. People hate taxes. But the amount that we have to cut is huge. If we were to just get out of this by cutting, you would have to defund the entire Department of Health in Wyoming, which isn't likely in a pandemic. You could also instead defund all of higher ed. That would be, shut down UW and all the community colleges. Then you'd shut down the entire justice system and close all the prisons. And that would get you 1.5 billion less in expenditures. Or you could keep those agencies open and you could defund the rest of the Wyoming government. So each of those areas is worth about 1/3 of total Wyoming expenditure. Another way you could think about it is maybe we could cut some workers. Well, in order to make that 1.5 billion, you could fund all the agencies, but you would have to lay off everybody and there'd be nobody left to do the work. So the message here is you just can't cut your way out of this. We're going to have to do other things. Luckily, the state has savings, what we call the rainy day fund. If we use that to cover the entire shortfall, we would use up our entire savings account by 2022. Ben mentioned we've been working on changing our revenue structure to deal with that shortfall, that structural deficit we talked about that was there before the recession. We thought we could use the rainy day to kind of paper over that to get us, the bridge that would get us to the fiscal changes we need. And we might need that. That might take about 5 or 10 years. The savings account could have done that. But if we use it for this recession, it'll be run out by the end of the next biennial budget. So again, we can't use just savings for this either. We're going to have to look at raising taxes. That was true before. But now with COVID, this has just accelerated everything. The underlying structural budget deficit hasn't gone away, but we're going to have to now use a lot of our savings and make a lot of very painful cuts to kind of square this circle. Some people might say, well, why don't we just borrow? Or maybe the feds will come with a stimulus package that'll get us over this hurdle. That's not really a long-term fiscally sustainable outcome either, because that might be a Band-Aid that gets us over the recession. But remember, we still have that underlying structural deficit that we need to deal with. Our energy commodities have fallen, and oil is likely not going to carry us in the long term the way we thought it was before. And certainly gas and coal aren't either. So this just kind of leaves us in the fix that we're in. So with that, I didn't make you drink through all of the word shortfall, but this is a pretty dismal forecast, but it gives people a sense of what we're looking at and what we need to deal with in the future. So it looks like we have a little bit of time for questions, so I'll turn it over to Steve if he has any.
Thank you, Rob, and thank you all for the great insights. A question that just popped up here is, and I'll just pose it to the group, and one or all of you can take a stab at it, is having had this conversation around taxes, the question centers around, will increases in taxes further hurt the state's GDP?
I can take a stab at that. The short answer is certainly it won't help the recovery if we have to pay more taxes. Taxes are always kind of a drag on economic recovery. On the other side, in order to diversify our economy, companies that may want to come to Wyoming want to be assured that they have high quality public services. So a potential benefit to taking more responsibility for paying our taxes in the state will be greater sustainability to our public services, which we are definitely going to need if we want to attract that new investment in new sectors. That really is kind of the long-term answer to rounding out our economy and making it more sustainable.
Yeah, I would second that as well. That when we're talking about businesses making decisions to locate families here, to support a workforce here, they want to see stability, because it's not just the workers for a business is locating here; it's also the workers and their spouses that are going to want employment in other areas as well. And when you're cutting government spending, you're also taking all of that economic activity out of the economy as well. That there's actually a stimulative effect, a stabilization effect from public spending there. And if folks are driving through your town on vacation, maybe they're going to Yellowstone and they see roads that are improperly maintained and boarded up retail establishments because of the last energy boom and all the workers that left an area because of that, that cyclicality actually has this other effect on the perception of our state, the lack of stability, the lack of certainty, and reduces confidence that people have generally in our economy going forward. So it's not an easy question to answer when you talk about tax increases versus reducing public spending. It's a difficult conversation to have. At the end of the day, there's probably going to be some expectation of a certain level of public expenditure, and we got to figure out how to pay for it. So.
One thing I'd add to Ben's comments, he mentioned at the very beginning of his talk, the share of government in Wyoming. And the fact that we have a relatively higher share is not due to the fact that we kind of have a fat state. It's really the fact that we have a very small state, and there's economies of scale in larger states and government services. The other thing I'd also mention is there isn't a lot of room for cuts before you really start cutting to the bone. We made a lot of cuts in our government agencies in 2016 in the last oil bust. And those agencies really didn't see their funding come back. So a lot of the fat that was in the system has now been really cut out of the system. And any major cuts we make are actually going to be very painful. We're going to be cutting away muscle. We might even be, cutting off limbs at this point, but that may be required. And it'll be up to the people of Wyoming how they see the optimal balance of cuts, taxes, and other mechanisms, for example, using our savings.
Terrific. Well, unfortunately, we've run out of time, and we did receive a couple other questions. And as I shared earlier, we'll make sure to share these questions with our experts and post them on our website as part of our FAQs. I'd like to thank everyone for participating in today's information session. And again, we appreciate the efforts of our faculty to bring these great insights. You'll also find a recording of today's event on our COVID information website. We appreciate everyone's partnership and hope they have a great rest of the week. Continue to stay safe, and thank you again for joining the College of Business in today's information session.